It's not your usual investing book. It's more like a guide to thinking.
Exactly. It's almost ironic. The title makes it sound like a finance manual, but the content, mental models, decision making psychology.
Let's dive into that. Mental models. That's where it all starts with Munger. He believes in a lattice work of models from multiple disciplines.
Right. And what stood out to me is how he thinks investors go wrong when they rely on just one tool, like finance theory or accounting.
Or as he puts it, to a man with only a hammer, every problem looks like a nail.
I've heard that quote 1,000 times, but in this context, it hits harder. Imagine being a fund manager who only thinks in terms of P ratios,
Yeah, you'd miss everything else. The moat, the management, the incentives.
or worse, you'd think you're being rational when really you're just limited.
Here's something that got me thinking. If Munger were managing a portfolio today with all the noise we have, Reddit stocks, memes, Fed cycles, how do you think he'd behave?
I think he'd do exactly what he's always done: tune out the noise, stick to fundamentals, but maybe he'd be even more ruthless about what he ignores.
So say you had a stock tip from a smart analyst, strong momentum, solid numbers, but you didn't understand the business. Would you touch it?
Before reading Munger, maybe. After reading him, no chance. If I can't explain why it's a great business in simple terms, it's out.
I'm with you. That's one of the most powerful lessons, staying within your circle of competence.
Which sounds easy, but it's brutally hard in practice. We're wired to chase returns, to imitate.
And the market punishes that kind of behavior eventually.
Eventually, but the timing can be cruel.
Yeah. And Munger's response to that is patience, extreme patience.
He talks about waiting for the fat pitch, like Ted Williams and the baseball analogy.
Yep. Just because the market throws pitches every day doesn't mean you have to swing.
But that's hard, isn't it? Sitting on cash, watching others get rich quick.
Very hard. Here's a hypothetical. Say you have 100K in cash and the market drops 30%. Media's screaming panic. Everyone around you is selling. What do you do?
If I've done the work and there's a company I understand with a moat, honest management, and a margin of safety, I'd buy. Not everything, but decisively.
And if you weren't sure,
I'd wait. Better to do nothing than something stupid. That's Munger's style.
doing nothing is underrated. Munger even said most investors would do better if they had a punch card with just 20 slots, 20 investments for a lifetime.
That idea blew my mind. It forces selectivity, discipline.
And conviction. If you had to pick just one stock right now, what would it be?
Maybe Berkshire? Ironically, because with Munger and Buffett at the helm, even if they're not forever, it's a collection of businesses with enduring value.
Safe answer, but smart. Berkshire's like buying into a philosophy.
A way of thinking, which is what this whole book is about.
Agreed. All right, let's take a breath here. Next, I want to get into the psychology of investing, biases, fallacies, all the mental traps Munger warns us about.
Can't wait. That's the fun part and the scary part.
All right, Chris, let's get into the mind games, Munger's take on human psychology. This was one of the most fascinating parts of the book for me.
Same here, especially the way he draws from psychology, not finance, to explain bad investment behavior.
Like social proof, commitment bias, incentive, cause bias. He makes the case that most mistakes come from poor thinking, not poor math.
Exactly. Take social proof. Everyone starts buying and you feel like you're missing out. Next thing you know, you've bought something you don't understand.
Herd mentality in action. But what struck me more was the idea of incentive caused bias. Munger really drills down on that.
Show me the incentive and I'll show you the outcome. That line is pure gold.
So true. Say a banker gets a bonus for pushing loans. Guess what he's going to do, regardless of risk?
You push the loans, it's predictable. And Munger's point is that it's not about ethics. It's about systems. Design the system wrong, and good people do dumb things.
That hit hard, makes you rethink everything, from business models to politics.
And investing, think about analysts hyping stocks. Are they giving you truth or incentives?
Most of the time, incentives, and Munger teaches us to spot that.
He also talks about consistency bias, how once people commit to an idea publicly, they'll double down even if the facts change.
Yeah. Like a fund manager who went all in on a tech stock. The numbers start to crack, but they can't back down because their reputation is tied to it.
I've seen that happen. Pride over performance.
So how do you fight that? Let's imagine you bought into a company you believed in, you told your friends, maybe even wrote a blog post, and then new data suggests it's a terrible idea. What do you do?
If I'm being honest, the emotional side of me would resist, but if I'm channeling Munger, I'd cut the ego and change course. Say, I was wrong.
Easier said than done.
For sure. But Munger gives you the tools. Detach from identity. Make decisions based on truth, not pride.
There's also the concept of man with a narrative bias. We want stories more than we want facts.
And stories are seductive. This company will revolutionize the world, right?
Yeah. Even if it's burning cash with no moat, we fall for the future dream.
That's why Munger insists on grounding decisions in reality, durable economics, not hype.
He's not saying don't believe in vision, but make sure the numbers and logic support it,
And understand how your own brain wants to trick you.
right? Speaking of which, the Lollapalooza effect, when multiple biases act together, that's when people do truly irrational things.
Like bidding wars in real estate. Scarcity bias, social proof, loss aversion, it all piles on.
Or meme stocks, the 2021 GME MQ wave, perfect case study, a Munger Lollapalooza.
Exactly. Emotions override reason, and people start doing things they can't even explain later.
So let me throw a what if at you. Imagine you're in a room with 20 people. 19 are buying a hot stock. They all made 30% last month. You're the only one who's skeptical. What do you do?
First, I check myself. Am I being contrary for the sake of it, or do I have real reasoning?
Fair.
If I truly believe the fundamentals don't support the hype, I'd stay out, and I'd remind myself long-term investing isn't a popularity contest.
Love that. But how do you avoid the pain of missing out? Everyone around you getting rich.
Munger would say, envy is a stupid sin because you can't even have fun with it.
Classic Munger, brutally honest.
But also wise. Staying grounded means learning to be okay with others winning in ways that aren't sustainable for you.
And that's a life skill, not just an investing rule.
Absolutely. Munger doesn't separate the two. Good thinking is good living.
Let's pause on that. Coming up, we talk about Munger's concept of value investing, the true meaning of a moat, and why most people misunderstand both.
Looking forward to it.
All right, Chris, let's dig into value investing, but not the superficial version. Munger's definition is much deeper than just buy cheap.
Absolutely. He redefined it in a way. Most people think value investing means low P ratios or discounted stocks.
But for Munger, it's about buying great businesses at a fair price, not mediocre businesses at a cheap price.
Yeah, that was one of his big disagreements with classic Graham style investing, cigar butt investing, as he called it.
Right? Those leftover scraps, a few puffs left, but no longevity.
And Munger was like, why not just find the businesses that compound, ones that grow and last?
And that's where moats come in. Sustainable competitive advantages.
Exactly. A moat is what keeps the competition out. Brand, scale, cost advantages, network effects.
Let's test that. Say you're looking at two companies. One is dirt cheap but shrinking slowly. The other is fairly priced but has a strong brand and consistent returns. Which do you choose?
I'd go with the second. The moat matters. Cheap doesn't mean good.
That's something I had to unlearn. I used to think price was everything.
Me too. But Munger's logic is solid. If you own a great business, time becomes your ally. Compounding works for you.
And if you buy a bad one, even cheap, time becomes your enemy.
Exactly. The longer you hold it, the worse it gets.
You know, Munger talks about the importance of return on invested capital. How that's more meaningful than just growth.
Yeah. A company growing fast but reinvesting poorly is just running on a treadmill.
But if it can reinvest at high returns, that's compounding magic.
Let me ask you something. Say you find a business with great returns on capital, a loyal customer base, and ethical management T. But the stock's expensive. Do you wait? Or buy in slowly?
Tough one. I'd probably nibble. Small position, track it, wait for a better entry. But I'd rather own a slice of a great business than miss it entirely.
I agree. Munger always says it's better to buy a great business at a fair price than a fair business at a great price.
Another shift he made from traditional value investing.
And he emphasized qualitative factors just as much as the numbers.
Yeah, like management quality, culture, incentives.
You can't quantify all that, but it matters. Think about Costco, classic Munger investment.
Yeah. Low margins, but loyal customers, operational efficiency, and smart leadership.
And he said he loved it because it worked for the customer. He always looked for companies that delivered real value.
That reminds me of his quote, "Take a simple idea and take it seriously."
Such a powerful principle. People overcomplicate investing.
Agreed. Let me throw another scenario at you. Suppose you find a company with a great moat today, but that moat is threatened, maybe by tech disruption or regulation. How do you think Munger would approach it?
He'd be skeptical. Moats aren't forever. He always looked for durability.
So maybe he'd pass.
Unless he believed the company could adapt. Munger valued management who could evolve.
And that comes back to what he called intelligent fanaticism, leaders obsessed with improvement.
Yeah, not charismatic egos, but rational, disciplined operators.
Think Jeff Bezos, low margins, long-term thinking, customer obsession.
Perfect example. Amazon wasn't about short-term profit. It was about dominance over time.
So the takeaway here, don't just chase numbers. Look for businesses with depth, economic, cultural, strategic.
And be patient. Munger's greatest edge wasn't IQ. It was temperament.
Patience and discipline may be the two rarest traits in the market.
And that's why most people can't copy him, not because they're not smart, but because they're not calm.
Powerful point. All right, let's shift gears next. We'll talk about Munger's views on diversification and why he thought it was overused.
This is where he really ruffled feathers.
So Chris, diversification. Munger really didn't hold back here. He thought it was kind of a crutch, didn't he?
Yeah. He famously said, the idea that you have to have 50 stocks to be safe is insane. He called it diversification.
And his point was, if you really understand what you're doing, you don't need to spread your bets that wide.
Right. Because you only need a few great businesses to win big if you're patient.
But that goes against most modern portfolio theory. The textbook says diversify to reduce risk.
True. And Munger says that advice is for people who don't know what they're doing.
That's brutal, but kind of fair.
Kind of. I mean, he's not saying don't diversify at all. He's saying know what you own. If you find 3 wonderful businesses, why dilute them with 17 average ones?
And he backed it up with his own behavior. Berkshire wasn't that diversified. Big positions in Coca-Cola, Apple, Costco.
And he was okay with concentration because he had conviction.
So let me ask, how do you know when you really understand a business enough to bet big on it?
Great question. Munger would say, do you understand the economics? Do you understand the moat? Do you trust the management? And most importantly, Can you predict what it'll look like 10 years from now?
That last part's tough.
It is, and that's why he only pulled the trigger a few times in his life.
It's not frequent betting, it's rare and rational betting.
Exactly. Patience until the odds are overwhelmingly in your favor.
So here's a scenario. Say you've studied a company for years. Everything checks out, you believe in the business. It's 50% of your portfolio now. News breaks that a new competitor is entering the market. What do you do?
First, I'd reassess the moat. Is the new entrant real competition or hype?
Let's say they're legit, they're cheaper, faster, more agile.
Then I'd have to admit the thesis changed. I might reduce, but I wouldn't panic sell. I'd want to see how the incumbent responds.
Measured response, not emotional.
Munger always said, invert, always invert. What could go wrong? Then stress test your ideas.
That inversion principle, I love that. Most people try to prove they're right. Munger tries to prove he's wrong first.
And if he can't disprove the idea, then he invests.
Very scientific, very stoic too.
Yep. Detach from the ego. Focus on process, not outcome.
You know what else Munger did that most people don't? He sat still.
Yeah, inactivity was a virtue for him.
People want action. They check their portfolios daily. They trade. He just waited.
He once said, the big money is not in the buying or the selling, but in the waiting.
Which sounds easy, but is actually insanely hard in practice.
Especially now, with the dopamine hit of stock apps and news alerts.
Exactly. Our brains are wired for movement. Munger trained us to sit still.
And that's the edge. Not speed, but stillness.
So wrapping this part, Munger says focus on a few great ideas, understand them deeply, bet big when the odds are right, and be still.
Simple, not easy.
Coming up next, we explore Munger's reading habits, mental models, and why multidisciplinary thinking was his real superpower.
Can't wait.
All right, Chris, let's bring this home. Mental models, Munger's obsession.
Yeah, he said. You must know the big ideas in the big disciplines, not just finance.
He was like an intellectual collector, psychology, biology, physics, economics, everything.
And he believed that problems become clearer when you view them through multiple lenses.
Like the concept of confirmation bias. If you know how that works, you catch yourself chasing information that supports what you already believe.
Or incentive bias. Munger always said, show me the incentive, and I'll show you the outcome.
That one changes how you look at business. Why CEOs act the way they do, or why a company's culture drifts.
Exactly. Incentives shape behavior. It's not always evil. It's just human.
Munger built this lattice work of models in his head, and he used them to make decisions better than almost anyone.
And he didn't try to be perfect, just less stupid than others.
I love that, aiming for worldly wisdom, not genius.
And wisdom comes from learning across time and disciplines. Reading widely. Asking better questions.
Speaking of which, let's throw in a scenario. Say you're 25, you've got some savings, a decent job, and a hunger to invest. You've read Munger. What do?
I'd say first, don't rush. Build your mental toolkit. Read. Think. Watch great businesses.
What do you read?
Everything. Not just finance. Biology, psychology, history, ethics. The more perspectives, the sharper your judgment.
Let's say this 25-year-old wants to buy stocks now. What would Munger say?
Probably say do nothing until you find something worth doing. And in the meantime, study relentlessly.
And that patience is probably the hardest thing to learn.
Yeah. Munger's brain was wired for long-term thinking. He could delay gratification like a monk.
That's something we should all practice. Delayed gratification.
Definitely. In investing in life, the payoff multiplies.
All right, let's zoom out. What's the big takeaway from the complete investor?
For me, it's that real success isn't about IQ. It's about rationality, discipline, and humility.
For me, it's that you don't need 100 ideas. You need a few great ones, deeply understood, acted on with courage and patience.
And the rest, tune out the noise. Think, wait,
Let me ask you one last imaginary question. Say Charlie Munger was 30 years old today, in this world with AI, crypto, social media, distractions everywhere. What would he do?
oof. I think he'd still be reading 8 hours a day, probably learning how AI works, understanding incentives behind tech companies, staying rational while everyone chases hype.
You think he'd invest in crypto?
I think he'd study it, then probably say something brutally honest about human nature.
Ha ha, yeah. Rat poison squared, or something like that.
But seriously, he'd filter out the noise, stick to fundamentals, and look for enduring truths.
And most importantly, he'd keep learning until the end.
Lifelong learning, lifelong discipline, lifelong curiosity.
And that's what makes him complete. Not just as an investor, but as a thinker.
Agreed. The complete investor isn't about tactics, it's about mindset.
And we all need more of that.
Couldn't have said it better.
All right, Chris, that was deep, sharp, and honestly, Munger would have enjoyed the back and forth.
I hope so. And hey, next time we'll tackle another great mind.
Looking forward to it.
Me too.
Thanks for listening, everyone. Stay curious, stay rational, and take it seriously.
Always.